All righty then. So for those of you who haven't been in a webinar with me before, my cat will participate at some points throughout this webinar. So she's 21 years old and deaf and likes to talk loudly. So I'll try to mute her out of the program when I can. But excuse my pet. So thanks for everyone who signed in today. For those of you who may not be familiar, the NPDA exists to support franchise and independent power sports dealers through education, advocacy programs, and practical resources, all with the goal of helping dealers to build a stronger, more professional, and more profitable industry. The NPDA Partner Series that we put together here is designed to give dealers direct access to the companies, tools, and people helping shape the power sports retail landscape. Throughout the spring and summer, we'll be featuring NPDA partners on an almost weekly basis, giving dealers a chance to hear firsthand where these organizations fit inside dealership operations and how their solutions can help stores become more efficient, more profitable, and better prepared for the road ahead. The goal is simple: keep dealers informed, connected, and exposed to ideas they can actually put to work. For today's webinar, we're joined by Silas and Jeff Barron from Brightline Dealer Services. Brightline works closely with dealers on F&I performance, reinsurance, and strategies that can help improve profitability while creating more consistency inside the dealership. Gene and Jeff bring a practical understanding of where dealers are winning, where they are leaving money on the table, and what operational disciplines can make a meaningful difference. During the webinar, if you have any questions, please drop them in the comments or the Q&A. Both should work. I'll either work them into the discussion as we go or save them for the end. As always, this webinar is being recorded, and the recording along with Gene and Jeff's presentation will be made available afterwards. Again, if you got any questions, just drop them into the comments. We are planning on running for about 45 minutes today, maybe a little bit longer, depending on what questions come up. With that, I will turn it over to Gene and Jeff. It's all you two.
All right, thanks, Marcus. So if I can get this technology working here. Jeff, does that look okay on there, brother? There we go. Hey, good afternoon, everybody. First of all, I want to thank the association for giving us the opportunity to participate in this. I say this often. I've told Tigger, I've told Kim Harris and Mark, all of them this. I work with a number of associations, and I enjoy working with the NPDA far better than any of them. Most of you, I think, probably know who I am. I've been doing this since the Marine Corps days. I got out of the Marine Corps, started in the business, and this is all I've ever done. I'm everybody says they're lifelong bikers, but I'm a lifelong biker, and more chances than not, if I come to your store, it's going to be on two wheels, as a few of you have already experienced. I just love the power sports business, and I'll let Jeff tell you a little bit about himself, and we'll get into the presentation.
Sure. Again, appreciate it, Gene. Appreciate it, NPDA. You've been in this business since 1999. I went to Northwood University to play baseball and ended up selling cars my sophomore year of college. So haven't done anything since, and been in this side of the business for close to 20 years. And look forward to sharing some things that we've learned with Brightline since we formed the company back in 2017, and as we continue to grow, and what's made us a top 80 largest broker of insurance in the United States in pretty much 8 years. So super proud of that, and we continue to grow, and we appreciate having us here.
I think everybody would agree. This is actually, I think, probably the most margin compressed environment that we've seen in the power sports world, auto industry in my recent memory. With the tariffs, with just everything, it's just a very margin compressed environment. So with that, I think we're in a game of inches, and part of how we increase on the inches is to look at how is your reinsurance structured, because how it's structured really determines everything from there. It's not so much about the reinsurance account as it is how this actually structured. How's the cash flow, the investment income, the long-term equity. I'd like to call it capital velocity. You can put the money in, but how quick can we earn the money out? Because that's always, one of the key factors, in my opinion, to how well your reinsurance is working for you. There's a lot of us out there, and we call it what it is. And I can tell you, not all companies are the same. Not all reinsurance programs are the same. As Jeff will get into just a little bit, there's a number of different triggers that you really, want to look for. Some of the downsides that I've seen as I've seen other, companies is, they have limited ownership or control. If you're in a reinsurance position, you need to be in control of what goes on with that. How the money comes out, how it's invested. You need to have that control. That's the reason that we like to be in these positions to start with. One thing Jeff is going to talk about, admin fees is always a very big discussion as we go into dealers. And I hear that more than anything. What's your admin fee? What's your admin fee? Well, admin fees, is pretty easy to pick out. It's the hidden fees that tend to trip up, most dealers that they really don't look for because a lot of times they're not disclosed. Lack of flexibility or exit options. I like to say, and Jeff will tell you this, it's not what you're making, it's what you're missing. And he'll go into that a little bit, as well. If you don't have the flexibility within your reinsurance position, the flexibility to, if the losses are high with a unit, can you change the reserve so that you can offset it? What are your exit options? Not just taking money out. If you, depending on what your strategy is, short term, long term, what are your exit options on that? The absolute biggest issue that I see in setting up any, not just a reinsurance position, but anything in a dealership is the misalignment between the provider and the dealer. The provider and the dealer's goals should be in tandem and hand in hand. So everything that that a provider does should go straight with the dealer and help them achieve whatever they're looking to do. And I can tell you, in my opinion, I say this a lot. All the structures are really good structures, regardless of what they are. It really depends on what the dealer's needs and goals are at that moment. What are they looking at 5 years, 10 years? And these are conversations that you have to have with your provider to make sure that whatever structure you're in is going to do just that. It's going to accomplish your long-term goals. Without that, you're just throwing money and hoping for the best. And, hope, in my opinion, is just not a strategy. Your structure needs to be convenient for you, not for others. Make no mistake about that. It is your business. We're, like I said, we're in a game of inches. You have got to make sure that your structure is going to work for you today and tomorrow and 5 to 10 years from now. Jeff, I'm going to turn it over to you, brother.
Yeah, sure. So, as Gene was talking about, the three participating structures that I want to talk about, that are really talking about, as Gene mentioned, it shouldn't be a one size fits all program. It should align around what are my goals? What particular tax advantages do I have? Do I want money now? Do I want money later? Do I want to continue to invest in my company? A lot of dealers we see take, pack money up front. And then others leave it within their reinsurance company. But then we talk about the tax advantages and disadvantages. We talk about capital gains and we talk about ordinary income tax and what makes each event a taxable event. And ultimately, when you talk about each one of these strategies, it really is about the capital velocity within your working capital within your reinsurance company. There's a lot of things that we've seen over the last couple decades with reinsurance. And unfortunately, what we've seen and continues to be the pattern is a lot of dealers and providers out there look at reinsurance companies as set it and forget it. And what we're going to talk about today is, it is great to start the reinsurance company, but it's, how you manage that company from day one. And it really shouldn't be, a set it and forget it. And every 3 months you're looking at your loss ratio and every dealer looks at loss ratio as success or failure within your reinsurance company. It is a big part of that, but there's also things that we're going to talk through today that are really going to help you think at a bigger scope of what your reinsurance company is. So today we're going to talk about your walkaway program or direct program as we talk about that, your retrospective programs, and then your producer-owned reinsurance company, or as we call PORCs or CFCs. So walk away in retro, again, direct programs. If you think about what are my goals, these are mostly, we see a lot of dealers, that sell gap insurance, the volatility of gap up and down. We see a lot of dealers putting their gap programs into a walk away or a direct program. The reason is because there's no liability. There's very limited potential for exposure because you're really not in an ownership position. The only way that you're allowed to, that you can make money is commission per contract through your F&I offices. It's ideal for your smaller, dealerships. And again, you don't want to have a whole lot of exposure. The dealer control, though, when you think about adjudicating claims, you really have minimal control as to how claims are adjudicated. Again, most reputable companies out there, administration companies, will adjudicate to the letter of the contract. So you're fine there. Again, you have no risk, and it is a very fixed upside potential to that. Now, once you get more comfortable into those programs, you can look at a retro program, which there is some profit sharing potential depending on who your provider is. You can participate in those underwriting profits, as long as they're in the positive side. You can get paid through commission, but you do experience some of that underwriting profit. Most companies you see out there will let you participate. With Brightline, we let you participate up to 90% of the underwriting profit. So really, you're only giving up 10 points to minimize some of that exposure in case, your reinsurance book does go upside down. Again, you're going to have a little bit higher potential for back end earnings. And it's, for those mid-sized dealers who really want to start dipping their toe into some reinsurance companies and really, get a piece of that underwriting income without that full risk in case it does go upside down. Again, your potential is limited, but it's a little bit better than that direct program. And, some of our dealers really graduate from the retro programs into the reinsurance programs. Probably on the automotive and the power sports side, we do see probably in the mid 90s of dealers participating in some form of fashion, whether it's a retro program or it's a reinsurance program. That's really, you talk about law of large numbers as you continue to grow. Again, we always ask, the first question we ask dealers is, what are your goals, right? And we can kind of help back that into the program. What you really want to look for in any type of program is that it's truly dealer centric. There's some flexibility to what they do and how they operate. And really, at Brightline, that's kind of what we've created. And we'll talk a little bit more about, the reinsurance programs next.
Hey, Jeff, do you think there's is there some kind of metric you look at that dealers should consider when thinking about whether they want to move into one of these programs? Is it the number of contracts they sell a year, the number of units? Is it dollars?
Sure. Yeah, great question, Mark. I think with a retro program, I think any dealer, no matter, 15, 20, 30, 30 units a month, with the right provider, I would most definitely look at participating in some form or fashion. If it's managed correctly, if you're managing it correctly, and we'll talk about some of those pitfalls that you can get into, when you talk about pre-owned units, pre-owned vehicles. There's some recon issues that you really want to be on top of. But at the end of the day, these insurance have a CLIP provider, what's called a CLIP provider, contractual liability insurance protection, that this contract doesn't go upside down, meaning claims are more than the reserves that are seeded into the reinsurance company. And we all know insurance companies aren't out to lose money. So if managed properly, you should always be reserved accordingly so that you're always going to see some benefits to that and some growth in underwriting profit.
Thank you.
Great question. So within the CFCs, as we said, the controlled foreign corporations or the PORCs, again, these are for growing dealers. As I said, probably 90% of dealers, on whether it's on the vehicle side, the motor vehicle side, or the power sports, probably over 90% are in some form of reinsurance program. There is some size limitations, which probably, the overwhelming majority of dealers fit under this scope, under an IRS rule called the 831B election. They changed that in 2025. It went from 2.85 million to 2.9 million in 2026, meaning for the tax advantages that dealers take advantage of through a reinsurance vehicle, you can cede up to $2.9 million per year in reserves within one reinsurance company. Now, if you have partners and there's multiple owners within that reinsurance company, each person under that reinsurance company can, fall under that 831B election. So technically, if you have a partner and you're 50-50 in a reinsurance company, you could see, close to $6 million, 5.8, I guess is the number, right? $5.8 million in reserves on an annual basis to still participate and fall under that tax advantage. Within the ownership structure, within that ownership structure, again, the dealer participates. Any reinsurance company, as I say, it's the dealer's reinsurance company of the dealer's contract. The administration company and the provider is to adjudicate those claims under the letter of the contract, right? So as a dealer, you have a little bit more flexibility for those dealers that, if a claim is adjudicated and it's, as written under the contract, it's a denied claim. However, the dealer has the ability to override those in some cases. Again, those claims are coming out of the dealer's reinsurance position. So again, you do have some flexibility within those customers that, maybe that gray area from a claims adjudication process that you can definitely take advantage of. The tax benefits, of course, as I mentioned, under that 831B election, that income can be tax exempt, for a certain amount of time, which gives you a lot of control over your reinsurance entity. And again, you can continue to scale it. We've got dealer groups across the country, 5, 6, 7, 8 rooftops that can still fall under that reinsurance, platform of the 831B. Now, as those three, if you talk about direct, and Gene, you can move forward. If you talk about the direct, the retro, or the reinsurance vehicles, you do have to talk about some of those blind spots, as Gene mentioned earlier. We do talk about admin fees. We know customers pay admin fees, but what we do have to be worried about, and a lot of dealers we're seeing have fees buried below the line, which, when you're reserving dollars within your reinsurance company, the fees that some of these providers and administrators have are below the line. So those come against your reinsurance position. And we'll talk about that here. And I've got a little example to show you exactly how much that can affect, money now versus money later. And really, the law of large numbers and compounded interest, it really can make a huge impact within a dealer's reinsurance company over a 3, 5, 10-year period. We talk about lack of investment control. As this money earns out, right, as a simple contract earns out through the life of that contract, you got to look at what kind of investment do I have control of? Even if it's an encumbered asset, what we call unearned premium, there are some things you can do, some vehicles you can do that keeps you a little bit ahead of the game and really earn some additional investment income, even while it's encumbered, because traditionally we haven't had that in the past. Some inflexible contract terms, there can be a one size fits all approach to a lot of these companies out there. And you just have to make sure as the reinsurance company that, hey, maybe I don't want those longer term contracts to fit under my reinsurance program. Maybe I want to change the parameters of a reinsurance contract. There is some companies out there that can do that and have done that. And that really kind of just sets, hey, what's my goals? What do I want to provide these customers and what's in both of our best interests? Because at the end of the day, we want this to be a dealer-centric program and a customer-centric program as well. Because it's all about that process. Once they purchase that service contract, what is the life cycle of that service contract? We want it to be profitable for the dealer, but also enjoyable and beneficial to the end user, which is your customers. If your provider can't explain your reinsurance model in simple terms, that could be something that I would be concerned about. We do see some session statements out there that can get 3, 4, 5, 6, 7 pages, and it really isn't that difficult. Again, loss ratio means a lot, and that's what a lot of dealers talk about. But it's how you get there is really what's important to dealers across the country. So this is what I was talking about. I've put together two different companies, Company A and Company B. Contract remit is the same, right? $1,107. And then we talk about admin fees, right? Admin fees are what the customers pay. So if you take the net admin, the admin fee of 207, and then you add it to the 907, that's actually a typo, but it should be $900 is the actual cost, right? So you have $900 of ad. It's not admin fee. It's actually reserve that you're ceding to your reinsurance company. Company B, same $1,100, the 189. So you have a little bit advantage over in Company B because of the less admin fee that you have. But here's where the rubber meets the road with what we call those fees. If you see that in Company A, you see that $907. We'll just use the 907, even though it should be 900. Those ceding fees, those premium tax, and the loss adjustment expenses are 3 fees that we see across the United States with admin companies and providers that take those dollars away from that $900 and continue to erode that, which takes those reserves out of the dealer's reinsurance account. So in this case, it's $18 for the ceding fee. The premium tax of 3% of that $900 is $27.21. Again, ceded premium. How much am I ceding to my reinsurance company? In Company A, they're only reserving $861, and in Company B, it's $938. So again, almost same admin fee, but those fees continue to erode the dealer's reinsurance position because ceded premium is where those claims come out of. So every dollar that you reserve in your reinsurance company, those claims continue to drive down that premium, which we call earned premium, which we'll talk about here in a minute. The other fee that we see is based on adjudication of claims. Some loss adjustment fees based on claims. They take 50% of the loss ratio. Again, in this point is 10%, which is $43. So again, your total reinsurance fees is $295 in example A and $189. So that's a difference of $106 per contract. Again, law of large numbers, if you're doing 10, 15, 20, again, multiple dealer groups, thousands of contracts, that really starts to add up because the conversation we're having with dealers today is, hey, it's $106 per contract. It's, X. What's the true cost of doing business with your provider? It's one thing to talk about $106 today, but as you'll see as we walk through your surplus accounts, how that can affect your compounded interest, not just today's dollars, that 106 5 years down the road and 10 years down the road for one contract. How much is that really costing you? So as we talk about, how do we manage our reinsurance portfolios? And truly, it's a balance of protecting it, increasing our profitability, and having those processes in place so that we're proactive to claims, right? There's proactive and reactive. We really want to be proactive. Every dealer that we do business with from day one, we have claims directives. There's a couple things that really affect the dealer's losses. One is early losses, right? I talked about the recon of pre-owned units, right? Are we really reconning those vehicles to the best of their ability? And we monitor 30, 60, 90-day claims for most dealers. And not only do we monitor those, we have basically what we call directives that we, let the dealer know, hey, we had a loss at 28 days on this pre-owned unit. How do we want to handle it? Yes, it's a valid claim, but it could have been pre-existing. So that's how we help manage that loss. Another thing that really, really affects loss ratios is what we call multiple cause of loss. A couple things happen on multiple cause of loss. If the vehicle goes to a different shop and the writer realizes that they have a service contract, they come in for one thing, and the advisor continues to get creative in finding multiple things wrong with that, again, it's all about the retention. So how do we retain those customers back in service? We talk about deductibles and having those disappearing deductibles if they come back to your repair facility. Those are some of the things that can help mitigate that. But also, we have to have those conversations internally with our service advisors, right? How can we make sure? Because we can sit down and look at three different writers, and there could be one writer that has a glaring difference that is really driving those loss costs higher because they're working their pay plan, and that's okay. But we have to realize, how can we control that, within that environment. Again, we talk about early and repeat claims to identify those issues. And again, we want to address those services or process gaps at the store level. Again, most companies look at us as F&I providers. We really work, not only in variable but fixed as well, addressing these issues before they become a problem within your own reinsurance company. One thing that we've seen, if you go to the right of that triangle, one thing that we've seen a lot in the last 7 years, you talk about the COVID pandemic, the prices increasing within your shop, parts, labor, parts availability, some of those things that are driving up those costs obviously are affecting the dealer's reinsurance. So how do we actively and proactively address any pricing issues as we start to see those prices increase? Unfortunately, a lot of dealers look at rate increases as, increase to help us. We're increasing rates to help the dealer maintain profitability within their reinsurance company and stay competitive in the marketplace. Again, we talk about lean inspection process. Recon is a huge part of contracts and how they're managed. And again, our ultimate goal is to reduce any unnecessary claims and improve the customer experience, because the last thing we want is your customers involved in the service department fighting with the F&I team because of the contract experience and any inspection process, et cetera. So that's some of the things that a good F&I partner will help tie up that process. Instead of making a right to the F&I department, again, it's all one team under one roof, and we're going to help drive that process to maintain that successful reinsurance company. So as you see within a reinsurance company, we're going to talk about two separate accounts. So we talked about that example of that $900 being in your reinsurance company. If you think about that $900 through the life of a contract, in some service contracts, we see 5, 6, 7, 8-year contracts. That $900 is going to earn out through the life of that contract. Again, the life cycle, the things that are going to affect that are claims. And we really want to help mitigate those claims. But how do we really reserve those dollars for dealers? As we talked about some of the approaches we've seen over the last 10 years, insurance companies won't let us invest those dollars because they're unearned. They're subject to claims and they could go away. So how do you manage that, and how do you really invest those dollars? And again, what we've seen is really simple fixed assets, very little equities, money market accounts that really doesn't drive a whole lot of investment dollars because those dollars are tied up. What you really want to look at is, hey, can I get an approach to where I can maybe do a little bit different investment program, maybe a little mix of fixed and equities in there to really help, invest those funds. We use what's called a collective investment trust fund. It offers a little bit different approach with a mix, as I mentioned, of fixed and equities to help maximize those investment dollars while they're still encumbered. Again, those encumbered dollars are still subject to future claims. And again, the insurance company's approach at the end of the day is they want to make sure they're in some safe investment structures so that it doesn't have a whole lot of volatility. Where it really gets interesting for dealers, and this is where it can be super fun to think about, as soon as those dollars earn out, there's a couple things that you want to make sure your current provider is doing or your admin company is doing. Those dollars, you want to make sure that those dollars go into a different account. we talked about the A account. And once those are earned out, we call that a B account. Those should be automatically swept at least on a quarterly basis to tell you that, hey, I can de-risk those dollars so it's no longer exposed to future claims or cancellations. It gives you a little bit more control and more flexibility to those funds. With our B account, we do what's like it's a 401k approach that gives you 7 different investments from a little bit more conservative to super aggressive, and it helps you manage that program. Again, at the end of the day, what are your goals? You want access to capital. You can take loan against that money. You can keep it in your B account and, again, invest it like you want to. You can take a loan against it. Again, once it hits the B account, though, the biggest thing, we talk about those tax advantages. This is now capital gains dollars, right? So if you want access to that capital to continue to grow, that's a capital gains tax advantage versus ordinary income. So how do we drive those dollars from A to B? And again, there's other ways to do that, but the main approach is really to get those dollars unencumbered to give you a lot more flexibility with those dollars. I'm going to turn it over to Gene to just kind of brush over some of the questions, and we can, talk about some of the questions that you may have at the end, but these are some of the questions that you should be asking.
I was telling Mark before we started this, we have these conversations, obviously, weekly with different dealers, and they're typically hours and hours and hours long. So we appreciate the opportunity to give you just a high-level overview, but I strongly encourage you, if you have any other questions or deeper questions, you can reach out to myself and Jeff, which I'll give our contact information again at the end, and we can have a confidential conversation and answer whatever you want. But some of the questions that you really should be asking, and probably asking pretty quick, is, hey, well, what are my total admin fees? Are there any other fees? Do you have the loss adjustment fees, or do you have a seating fee? Any other fees that are not disclosed, what are they? And really have your provider break those out for you so you can get a clear picture of what your fees are in your position. And where are they disclosed? The admin fee is pretty simple. I mean, it's going to be disclosed 9 times out of 10 in the administrator's contract. But where are the other fees, disclosed? Typically, the seated fee is disclosed way down if it's disclosed at all. Just make your provider, pull your deal agreement up, or you pull it up and go through it and see if you can identify where those fees are at. A big question that comes up a lot is who actually controls your reinsurance trust and investment strategy. You have say, especially as it goes into your B account, is earning out, with who controls the investments of your money. Because keep in mind, that's just like a checking account or 401k. That's your money. You can control it. You can invest it however you want to invest it as it earns out. You need to really know who is controlling those investments as your position grows. We do something called accelerated earnings. A few other companies do as well. Do you have any options for that? Now, what that means is rather than waiting, say, 5, 6, 7 years for a contract to earn out, there's ways that you can add some premium to it that earn out in 13 months. Now, if you really want to drive capital, that is one of the ways that you can really drive it very, very quick. And I'll be more than happy to have that conversation, as will Jeff, after the call or what have you, to explain that in a little more detail. I always say it's not how you get married, it's how you get divorced that matters. What exit or conversion options do you have? So if you want to exit what you're in, maybe to go into a different structure, you're growing, you want to go from that retro to a CFC, as Jeff was discussing. What are the options to do that as you grow and scale your business? You need to have a clear understanding of what those options are. $1 million question that you need to ask yourself right now is, does your structure scale with your dealership's growth? I have conversations with power sport dealers all the time. One just probably 2 months ago, he's got a couple stores, but he's wanting to grow, to 8, 9, 10 stores. Well, you've got to be aligned with your provider to make sure that you are growing together, because you don't want to be growing that and provider not, coming up with you. So make sure that the structure scales with your dealership's growth trajectory. Okay. Is your models aligned with your financial operational goals? That's, again, that's a key question you have to ask. When is the last time? This is something actually I had this conversation with, held just yesterday. When's the last time you actually look at the contract costs were repriced in a way of price to your market or the national rate? The tariffs really made across the board, the power sports and auto industry, it made a step back and really look at our reserve cost. Because keep in mind, in a reinsurance position, as Jeff mentioned, if the costs go up, it's not the provider making more money. It's the provider moving your reserve because the cost of everything is going up. But conversely, if you have not seen that happen, then you're going to start recognizing much higher losses, in your position. You really need to take a look at that. Has that been repriced? Has it, what's the strategy for, pricing where it needs to be so that you can maintain a lower loss ratios? What are your loss ratios? I look at 36 to 90 days. Early claims, that's typically an indicator of reconditioning process. But what are your loss ratios? More times than not, when a lot of providers go through loss ratios, they'll look at overall business. What I suggest, especially in power sports, being, most of you guys have multiple franchises in the same, buildings. I would look at loss ratios by make and model. And if you see a unit that's has higher loss ratios than most, you give it to your provider and see what can be done to adjust your reserve to address the loss ratio on that particular model. That is part of what we should be doing for you, and you need to be looking at as well to really control and make sure that you're maximizing your earnings coming out into your B account. We got to control the loss ratios.
All right.
Partnerships, like I know we're winding down here, and I apologize. But whoever you partner with, they need to have unbiased insights across all the reinsurance models. We like to say we're agnostic to the model you want to be in. I'm a believer in showing every model that's available to you. You guys, I've found that most power sport dealers are some of the best business people that I've been around. So you know what you want to do, but you need to have all of the information there to make that decision agnostically. Get obviously support from the experts is what we do every day. Focus on a long-term partnership, not just something that's a short-term gain. I always like to say, I don't want to partner with somebody, for 6 months or a year. I want to be able to grow with that company so that we all, do better in the end. And, true advisor is going to ensure that whatever structure you are in is working for you and not the other way around. And that's an important part of what we are. It's an important part of who you guys are. When you sell a unit to somebody, you want it to be something that works for them, not just what's going to make you the most money, because that's how you build long-term business. All right. I promise you, Mark, it's probably the last slide here. What structure fits you? Make sure you retain more profit for every F&I deal. And, unlock your new investment income. Really look at your B account. How's it been invested? How can you drive that investment income? That is something that most people just do not look at. Let's improve your liquidity, cash flow. You really need to have the flexibility as you scale to adjust your position as you go forward to change it around. And maximum tax efficiency legally and strategically is absolutely imperative. That 831B election, make sure that you understand it, make sure that you're within the limits of it, so that you don't have compliance issues going down the road. And that's something that we'll be more than happy to help you with. All right. Is the QR code, scan it. I'm gonna leave this up here. You can call me. Most of you know me, or Jeff, and we'd love to have open conversations with you. We have them confidentially anytime.
Got a list of questions for you here, so I'll pose them to you openly, and you two can decide who's best to answer these. A lot of finance managers tend to default to the longest ESC term that they can offer customers. And the reality is that the trade cycles for a lot of customers are shorter than that. How do you recommend that dealers adjust the terms that they're offering extended service contracts for to make sure that we're not over offering those products to these customers?
It's a great question. Jeff, if you don't mind, I'll take that. That's not
Yeah.
so much an issue with the term as much as it is an issue with your F&I process. If your F&I managers or whoever is going to send a customer is not having that customer interview and actually setting the product for their needs, then all they're going to do, and look, I was one of the world's worst at selling a 5-year, 100,000-mile warranty when I came into F&I 1,000 years ago. F&I managers get used to selling a certain term. That's just what they're comfortable with. What I have learned is you're better off selling a customer based off their driving needs. How long are you going to keep the vehicle? How many miles are you going to drive? What are you going to use it for? And sell that customer that policy based off of that. Any provider should be able to sit down with your F&I managers, do deals with them, and actually teach them how to do that. Again, that's not an issue with your term as much as that's an issue with your process.
That leads into the next question. If a dealer decides to partner with you on reinsurance or retro, do you offer training to their finance people on their team?
Probably more than they're going to want to see us in there. I promise you that. We do. And, for me, and Jeff would testify this. I say this all the time. I love the business, right? So, and my main objective outside of just training F&I manager is, hey, how can I help a dealer sell more units? Because at the end of the day, that is what matters. I can train an F&I manager till I'm blue in the face and they're tired of listening to me. But if I can't help the dealership acquire more customers, sell more units to put into F&I, then nothing else matters past that. So for me, I look at it holistically because come from my background, I was operating partner stores. I look at it through that lens. We got to drive business, driving business to F&I. How's that drive business to service parts? It works all the way around. That's got to be your key focus though. How do you sell more units?
I didn't get a name on this one, but for larger organizations, do you have any commentary on captive insurance other than F&I?
Yeah, I'll let you take that, brother.
Yeah, so in the healthcare space, I think Gene mentioned this early on. So we started an F&I business and now also provide employee benefits and property and casualty to Powersports and obviously automotive dealers as well as RV. We actually have started a lot of dealers. You talk about self-funded, level funded. It's almost like a reinsurance for healthcare, and depending on the structure. Again, what's my goals? With healthcare within a dealership, we do look at different options for self-funded, level-funded, self-insured programs on the healthcare side as well. So again, the insurance company is there to help regulate it, and it's all about managing, and that's what you rely on a company like Brightline to do, is to help you manage those products and procedures to really help manage those. So on the healthcare side, I can speak to it because we've had a lot of dealers across the country that have good success in those self and level funded programs just by paying attention to their people and to their results.
So that was the second part of this question, and I think you covered some of it, but it related to healthcare. And I guess I'd kind of expand on the question that came in just a little bit. What is kind of your solution that you're seeing for healthcare? So is that dealers are self-insuring some level with some overarching insurance that sits on top of that, or what are people doing?
Yeah. So, depending on the size, obviously, it's the same thing with F&I reinsurance. The larger you are, the scale of large numbers or the law of large numbers will help you scale and manage the program a little bit easier. Because I know in the healthcare side, I'm not on the healthcare side, but I've been exposed to it a lot since we started writing in 2021. We talk about the 80-20. It's really like I think it's like 5% of the employees are, responsible for almost 90% of premiums that go in and out of, and claims that go in and out of your company. And it takes, we actually have a very concierge like approach on the healthcare side that really helps manage those programs for you. But at the end of the day, it's all about managing and creating processes within the dealership and creating the right program based on, previous experiences.
So I know a lot of people don't like calling out the players in the industry, but anybody who knows me knows that I don't have any problems at all doing that. Since you have access to a lot of data, what brands do you see that have both the best and the worst loss ratios?
Do you have that information?
On the power sports side,
Yeah.
I don't have that information in front of me. On the power sports side, it's something I can definitely work with our providers to get you exact data. If I told you, I'd be lying to you. Because I know there's some highs and lows, and it's very sporadic depending on the model years, et cetera. Um, Gene, I
Are
don't
there
know
any
if you've seen anything that some high loss costs within some of the
Well, that's,
manufacturers.
that's actually a great question, and I made a note. I'm going to find that out today, Mark, and I'll send it to you because I'm curious to know that myself. Um, having Indians and having probably 50 Harleys through the years, I've had very little issues with any of my bikes. But I think the challenge for most power sport dealers is they just have so many brands, and that's what I want to make sure that I'm precise on. I'm kind of like Jeff. I don't want to give an answer and it not be 100% correct. So I'll have that answer for you by the end of the day, and I'll send it to you to send out to everybody.
the are there any products that you recommend that dealers don't reinsure?
Yeah, for sure.
Okay.
That's the big ones. Gap's just in my opinion, it's the probably the most one of the most valuable products that a customer can put on their vehicles, but it also is the highest loss out there. Outside of that, really, Mark, what you can do is as you put products in, again, it's your position. So if you start seeing losses go through the roof on something, you can always adjust at that moment. Either adjust reserve up or say, hey, you know what, the losses on this are so high, we just want to pull it out, and then you just whatever's in there goes to run off, and you can just write it direct from there.
And
And
you're okay
I'll
with
add to that too, Mark. One thing that we see, the only thing from a reinsurance position that can really harm a dealer is mismanagement of a program
Hmm.
and volume. If you're doing 10 to 15 contracts a month, that's really not going to help you in a reinsurance. Again, law of large numbers is a huge game within the reinsurance company. But number one, you have to manage the program correctly. Obviously, hopefully your provider is doing that for you proactively. But number two, you do have to have some volume, and it doesn't have to be a significant amount, but as long as it's managed properly, to Gene's point, gap is the only thing that's volatile these days. And at the end of the day, insurance company has these products reserved properly. Those actuaries, as crazy as it is, they can dial those numbers in pretty well, and the insurance company is not going to lose. So, if at all possible, look at reinsurance and have somebody manage it properly for you.
for most of my career, I think dealers reinsured through the Turks and Caicos or one of the islands, and now I'm starting to see a lot of dealers are you setting up reinsurance through a tribal land. Pros and cons to those, and you have a recommendation?
Yeah, a lot of the companies today are going to the Delaware tribe, just because it's easier to form. The Turks and Caicos is where most of them sit today, but the formation time can anywhere be between 3 and 9 months. The Delaware tribe can get it done domiciled in the United States in about 30 days. So it's a little bit quicker, a little bit easier. Tax benefits stay the same. So it's just all preference on how quickly you want that turned, and at the end of the day, the admin's going to dictate whether they want to do the tribe or the Turks and Caicos. But there really isn't much of a difference other than formation time.
Do you think that a dealer should let their employees know that they have set up a reinsurance company, or is that something that's typically better just kind of we're signed up with this new company and that's who we're going to be using going forward? Recommendation?
I'll tell you, in my opinion, that's actually a very good question, and I'm very transparent. The stores I've ran have always, let the every employee know everything that was going on, and again, as you're growing your business, we focus on customer satisfaction, but very few dealers really look at, hey, how satisfied are my employees? That's why we see such high turnover across industries as a whole. I never have a problem letting the employees know that something's reinsured. Just again, as you start selling these products, it just gives them a level of confidence that, hey, you know what? I have, ABC dealer is going to be behind this no matter what. But at the end of the day, I think it makes them feel invested that they do know. I think the not knowing more times than not for employees is the issue that a lot of places have with the turnover. You can't really keep people in the dark anymore. Everybody, anybody that's been in the business any length of time understands, that, hey, the dealer more likely has a reinsurance, type of position, especially managers, or they should. So I've never had an issue at all letting especially my management staff know what position that we were in.
Well, one thing I'd like to just add to that real quick, Mark, with that it comes up a lot in the automotive space, about having the manufacturer coverage, and a lot of F&I managers get worried about, selling a non-branded contract versus the manufacturer. It's all about a training, and the WIIFM, it's the salesperson's favorite radio station. What's in it for me? And at the end of the day, truly, with the right program, the customers, you have more flexibility with those customers on claims, right? Because the manufacturer program, they're just going to adjudicate to the letter of the contract and be done with it. If for any reason the dealer or anybody within the dealership management team feels that, hey, this should be a covered component, or it should be covered in this situation, but it's not covered under the letter of the contract, guess what? The dealer can pay for it. And guess what? Most companies should answer the phone in less than 20 seconds on any claim issues. So you definitely have a lot more control under the dealer's reinsurance program versus the manufacturer. So I think it just comes down to training at the end of the day.
If a dealer knows they're going to sell at some point down the road, or it's always the potential, what happens to these plans that a dealer has set up because they are somewhat kind of tied to that individual dealership?
So they have two options. One, they keep the reinsurance company open and let it go into runoff. So claims will be adjudicated against those, that reinsurance company until the last contract is earned. Or in some situations, we will actually buy those reinsurance companies out from dealers who just want to get rid of it and don't want to have any more exposure within their next business or whatever they're going to do. We will buy those out at a certain dollar figure, and based on the current loss runs, and manage that for them and take all the responsibility away from that reinsurance company.
Kind of like that company who advertises the payout for the structured settlements.
Correct.
I want to use any names and get any trademark violations by bringing that up. So Ernest T. Tubbs or something like that. I forget what that company's called. The last question that I had for you, there's a lot of companies that play in the space that you play in. Why would somebody choose Brightline over all of the other companies that operate in this space?
Mark, I can tell you, I've got some really good friends that are, I hate to call them competitors because, we're all friends, but NPDA is very fortunate that, we have some really good F&I providers that are, in this association. I think the thing that separates, us, is in particular me, from every other provider is I teach people and dealers how to sell more units. And again, you can train F&I until you're blue in the face. But if you can't teach a dealer and their staff how to be better with the customers and sell more units, nothing else matters past that. And that's really the differentiator factor between us and the other companies out there. Is I just have not seen that a lot from any of the other companies. And that's no disrespect to anybody we have in the association.
Cool. Well, I think we have worked our way through all the questions. Did you two think about anything else that wasn't in your presentation that you wanted to bring up before we wrap up today?
We got 5 more hours. We can lay it all out.
I can only give you three, so that's it.
All
I
right.
Hey,
gotta
no,
hop on.
I got to tell you, it's a tremendous honor to even sit here and have the opportunity to do this, Mark. And I really appreciate you guys. And I'm sure Jeff will echo that sentiment. Just give the opportunity to do this. And I do encourage if anybody just has questions, just call. We can have a conversation offline, confidentially, what have you.
Yeah, again, appreciate the opportunity, Mark and NPDA, and if there's any questions, please let us know. I know it's a lot to cover in 45 minutes, and it can be a lot, but it's not a one size fits all puzzle, and we work through that together, and willing to do that for anybody on the call here.
Well, these partner series podcasts have been, kind of something impromptu that I just decided to put together, and you were one of the first to raise your hand, so we appreciate that. We appreciate your partnership with the NPDA, and we appreciate all you do for the industry. So, we're kind of a small bootstrapped operation at this point in time, and we're trying to make a dent and trying to make things better for dealers. So we appreciate everybody that is helping us to accomplish that mission. With that, I just kind of shared our NPDA member program. So pretty cheap to join the NPDA and support what we're doing. So we currently have almost 50 partners at this point in time, like Brightline, that offer a variety of different programs that can help dealers out in a lot of different areas of the business, from credit card processing, insurance, you name it. We've probably got somebody at this point in time. So $400 a year, not a whole lot. And we've kind of figured out that if you took advantage of all the partnerships that we've got going, you would see about $60,000 in savings per year. So little price to pay. And we are going to continue this partnership series through the rest of the spring and the summer. I'm the only one doing this, so I've got to fit it in with my travel schedule, but kind of keep an eye out for these notifications to go out by the NPDA or me on LinkedIn. So we're going to continue to do these on either Thursdays or Fridays, mostly at 2 or 3 o'clock, just kind of depending on what we can find available in the calendar. So with that, I appreciate everybody that logged in this afternoon and attended this. I will, in the next couple of days, make this recording available for everybody. So if you had anybody else that wanted to watch it, or you just needed to go back and look at something, or you just needed contact information for Gene or Jeff, then all that will be available to everybody as well. So with that, I'll wrap it up. Oh, actually, it looks like I just got one more Q&A came in. So, uh, cool. It was commendation for job well done. So appreciate you two taking the time, and everybody else who logged in this afternoon. So I hope you all have a great weekend. And it's April. The talking to dealers across the country, things are really started to pick up over the last couple of weeks. So go out there and let's make the best of this year that we possibly can. Y'all have a good afternoon and a great weekend. Bye bye.
Thanks, Mark.